Okay, welcome everybody. We are live. So this is episode 19 of the Volatility Barometer. That name actually might be changed. I've got this name in my head that I just can't get away from. We had basically a naming competition within the VTS community where I polled everybody and asked them to submit their names. It's going to be lifetime subscription for anybody who picks the winning name. And as it turned out, I kind of defaulted to what I had before, which was the Volatility Barometer. But there is one name in my head that somebody recommended that I can't really get away from. So next time you come back, you might actually see it. But thank you everyone for showing up for this. You can see I'm in Vancouver again. I was in Panama for a month. So new scenery, new background. Hopefully we get lucky with the sunshine and it doesn't start blasting on my back. If it does, I'll have to close the blinds. But give you something to look at there. So, yeah, my 1 month in Panama is over. It was okay. It was all right. Little bit of good and bad. I can't say I loved it, but it was definitely an experience. So I will go back in 5 or 6 months. I have a few signatures to sign still, finalize the process and everything. But from this point forward, I think I'll focus in other areas. So. Give everybody a couple seconds to roll in here. Going to be talking about the VIX futures essentially today. So a little bit of a rundown. I'm going to add something new to the live streams. This first one, Volatility Lingo. Every week, every live stream, I'll break down a subject. Very simply put, just define it and, explain a little bit about what it is. So today, because we are talking about the futures, I think it's fitting to start that new segment, Volatility Lingo, with an explanation of what Contango actually means. So we'll start with that. Then we'll get into what is currently a pretty solid streak for VIX futures Contango. So I will highlight, how long it's been and what that means for the market. And then we'll do a deep dive into the actual VIX futures. I'm going to share a bunch of data, long-term trends, averages, percentiles, bunch of information that might give you an idea of where we currently sit and might influence a little bit of your trading. So after that, we'll just highlight a few of the things that I've done since the last live stream. Spoiler alert, not a whole lot because I've been traveling. But then, of course, we'll get into the open Q&A. I think a lot of people are here for that. They like the Q&A. It's, good place to get your questions answered. So we will get into that. But let's do the intro, and then we'll just get right into it, because there's actually quite a bit to talk about. Of course, the VIX futures is pretty much central to a lot of the things we talk about. So want to give as much time as possible for that, plus the Q&A. So thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so one thing I have to ask. I hate asking this, but it's coming. Please, if you wouldn't mind, give the video a like for me. Try to get that engagement up a little bit. It's free to follow my videos, the live streams. I don't ask for anything. Don't super chat. If you've got that set up, don't send me any money. Basically the entry fee for the live stream, just give it a like for me. It'll trick the YouTube algorithm into thinking I'm much more popular than I am. So if you wouldn't mind doing that for me. And then let's get started. Let's dive into these subjects. So the first thing that I wanted to explain Typically, I will do the volatility lingo later on in the show, but I think today, because it's so central to what we're doing, it makes sense to do it now. So let's try to define in simple terms what contango actually is. You're going to hear this term an awful lot in the volatility space. Make sure I am on screen share here. Okay, so what contango is, essentially, here's the VIX Futures term structure. Now, what this is every one of these points is a monthly VIX Futures contract, right? And they go out, this is the front month contract, this expires in August, September, October, November. They go all the way out in the future. And they can align themselves pretty much any way that the actual open market is trading these futures. This is a freely traded market. So there's nothing saying that it has to align itself in this shape. So what contango is, in the simplest possible terms, you might get some people try to get a little bit complicated with it when they're talking about the theory of contango or, normal backwardation, normal contango, things like that. But essentially, all it is when the further dated contracts are trading at a higher price than the shorter month contracts. Now, normal contango for this entire curve, if you wanted to say a full contango curve, it would be this contract trading higher than this one, all the way down the chain, this one higher than this one. This curve, as you see it right now, is called contango. I would call this a fully contangoed curve. There's a little bit of a kink here, but basically every single future is priced higher than the previous month. This is contango. Now, for us in the volatility space, the volatility ETPs that we trade, they all function based on a set methodology. And that methodology is holding a composition of just the front 2-month VIX futures. So just this August and September, and none of this matters right now. The price of the VXX, for example, the original product that launched back on January 29th, 2009, that original product only holds these two futures, and then depending on how those move around as we approach the VIX index at expiration, that's what's deriving its value, its price. So basically, when we're talking about contango in the volatility space, might be different if you're talking about oil futures or gold and silver futures, commodities and whatnot. But for the volatility space, contango is even simpler than that. It is just this second month future above this front month future. That's it. If this is higher than this, you can say that the VIX futures are in contango. And people in the volatility space will know what you're talking about. So that's really all contango is, just that above that. Now, I will say that as far as actually trading the volatility ETPs, there is a whole lot more to it and more that you have to understand. And contango itself isn't actually that important with respect to trading the volatility ETPs. So if you are a VXX trader, a UVXY trader, SVXY, these products that we know, they're all front month products, same with VIXY. These are all front 2-month products. But to actually understand how they move, you want to go a little bit further than this contango. But just as a straight up definition, that's basically what we're looking at. The second month future above the front month future, that's VIX futures contango. So pretty much as far as definitions go, I think the next stream we might come back and talk about backwardation, but that's pretty much it. But what I wanted to actually get into now, let me do a screen share, make sure this is all right. We are actually in a streak of contango, right? So remember, M2 above M1, that's why I always say M1, M2, VIX futures contango. We are actually seeing quite a long streak currently. So these VIX futures that I was just pointing to, M2 has been above M1 for now, what is going on, 132 trading days and counting. This is a very long streak, 6th longest since VIX futures launched, all the way back in March 2004. Pretty solid streak. I'll get into in a minute why you might be able to make a case that it's actually been a little bit longer than that, because it was actually only interrupted by a single day. But yeah, very, very long, solid streak of VIX futures contango. So regardless of what you think about the markets, whether it's unsustainably high, which you hear a lot about, the Fed is just injecting massive stimulus into the market. The government's going to start doing their massive fiscal spending. Say what you want about the market, but the volatility space itself is starting to show signs of normalization, represented by a pretty long streak of VIX futures contango. Now, it's not overly high, as you can see here. The M1, M2 matters, like I said, but other metrics matter more in the volatility space. And one of those is the VX30 to VIX roll yield. So I will probably do a future stream on dozens of volatility metrics, but VX30 to VIX roll yield is actually more important than the M1, M2. So you can see the average during all of these streaks, the top 20 longest in the last 17 years, 12.35 is what it averages. And we're at 13.27. So you could say in line, right? It can get to 14. There's a 15, nearly 16, 17, 16. There's quite a few, 16 there. We're basically average. The one thing that I did want to highlight, though, is this one here. This is the daily return of a short VXX position. So 0.5% per day. Now, the average is 0.4. If you are curious where that ranks historically, what we've got here, we can see this is including all days. Since 2004, how much the VXX, that front 2 month, 1 times volatility ETP, the VXX, how much it actually decays long term. Per day, about 0.24% per day. Now, this does include all the spikes as well. It includes every single day going back. So naturally, if you're in a streak of higher contango, we would expect this to be decaying faster. And that's what we actually see. So like I pointed out, we've got the current decay at about 0.5, long-term 0.4. So you could say roughly double. When you're in a streak of contango, especially one that's lasted this long, you can expect the VXX to decay about twice as fast as its long-term average. Right? For all of us short volatility traders, that's essentially what we're trying to do. Now, another side note here for anybody who's in the VTS community, I do actually track that number every single day. Remember, that average 0.5 is for the entire 132-day period. But I actually track it every single day with what I calculate myself as the VXX crush level. And today, it's actually 0.85. So the VXX, given all current underlying market conditions right now today, the cash VIX oscillator, which is essentially my own calculation of everything that the cash VIX term structure means, extremely high right now. We're in the 98.6th percentile. We've got the adjusted futures here. We've got the volatility barometer dip below 30. So all current conditions right now, VXX is actually decaying even faster, 0.85% per day. So you could honestly expect, if the market stays completely stable, keeps marching higher, keep all-time highs, all of these metrics stay very elevated. VX30 to VIX roll yield is in the 93rd percentile right now. If everything stays the same, we could actually expect the VXX to go down about 4 or 4.5% a week. So interesting information there for all you volatility traders. But yes, we are in a very, very good streak right now. So I lost it. I closed a window here. Give me 1 second here. Close something that I was actually supposed to keep open. Yeah, sorry about that. I lost my train of thought there. But yeah, basically, there it is. Found it. Okay, sorry. Apologies. What I ended up closing was on a long-term chart, if you wanted to see it, sometimes I like to get a glimpse of what it actually looks like on a long-term chart, where that contango is happening. You can see here, these are all of those streaks basically highlighted for the last 17 years. And of course, before the financial crisis, pretty good streaks there, 2003 to 2007-ish, pretty good short vol period there for anybody who was in the short vol trade. Of course, we didn't have volatility ETPs, but derivatives trading and whatnot. And then we had an extended period, of course, during the financial crisis where nothing was happening, pretty much grinding there. And then what we consider the golden years for the short vol trade right there. We've got several periods where we got on some pretty good streaks. And then, of course, right here, this very steep drop, of course, happened because of Vol-apocalypse, February 5th, 2018. And we haven't really seen a whole lot of traction since then. Markets have been bouncing around, and while we have had certain shorter periods of contango, this is the first significant sign that we have seen that things are recovering. Now, again, I definitely want to highlight the fact that I understand a good percentage of you are going to think that that's unsustainable, unnatural. It's all a facade. It is what it is. I mean, for me personally, I am a trader. My entire net worth is in my strategies. I can't afford to be playing that game where I'm anticipating several months from now something's going to happen. My money's in something today, and I have to trade what's directly in front of me right now today. So while I can kind of agree that this is a pretty insane market and certainly unsustainable and a lot of underlying problems under the surface, doesn't matter. We have to trade what's right in front of us right now today. And right now we are in a pretty solid streak of contango. So interesting data for you to look at there. Now, beyond that, beyond contango, because it's important to understand that in the volatility space, and probably it applies to all trading, absolute values don't really mean anything, right? If I tell you, what is contango at right now? Let's just look at that. If I tell you that contango right there, 10.58%, well, what does that mean? I mean, clearly it's positive, but we know that the VIX futures are most of the time in contango. So obviously we have to have some data and we have to track it to make sure we understand relative value in relation to some other things, in relation to itself over time. That's really what we want to know. We want to try to figure out some actual data. What does that number mean? Right, 10.47 as current today value. Am I screen share? Yes, I am. 10.47 right now. Well, that number in itself doesn't mean anything. But when you compare it to the long-term median, which is 6.39, and I do think the median is more important than the mean, just a little side tangent. The mean is basically just adding up all the numbers in a series and then dividing by how many occurrences there are. So this is the long-term VIX futures, M1, M2. Basically, the mean is just adding all of this up and dividing by how many days there were. I don't know how many days this is, thousands and thousands of days. The median is the exact middle number. And I think given the fact that we can see very extreme ends of the spectrum, both high and low, I always think median is more meaningful. So 6.39 is the median. Yes, we are currently fairly high, 10.47%. Could definitely make a case that right now, the VIX futures contango, the curve is quite steep. If we go a little bit further, this will be a future volatility lingo episode, but percentile rank. What percentile rank is where is the current number in relation to itself. So this 78%, it means that 10.47, where we sit currently right now today, is in the highest, basically 22% of all values going back to March 2004. So basically, top 4 out of 5 values. That's what we're seeing. Relative to itself, where we are currently right now is pretty strong. And I always like to look at these. Just for me personally, everybody's going to have their own way of trading. But for me personally, when I consider contango significant, I'd say over the 70th percentile, which is about 9% contango. That's significant. When it's in the 30th percentile, this means that it's only higher than 30% of the values going back to inception. 3.09, still a positive number. So knowing that we're in contango itself, just simply knowing that this value is above this value, that's not really good enough. That doesn't really mean much because even in the lower end percentile, where clearly the VXX, UVXY, they will not be behaving very well in that point, it's still a positive number. So you might be confused to think that, well, anytime it's positive, I'm supposed to short volatility. I can't tell anybody what to do or what not to do, but that is, in my opinion, not a very good way to trade because the results get really, really poor when you're down to this level. What I would say is, in general, pretty much everybody knows. I mean, speaking to the audience right now, there's maybe 100 people here. I would imagine pretty much all of you know what to do right now, right? Contango is in the, as we saw, the 78th percentile. When we've got decently high levels, you all know what to do, right? I've been short vol for a while. We're probably all short volatility. We all know what to do when it's obvious. We all probably know what to do, maybe a little bit less of us, but we generally know what to do when it's low, right? When it's below the 30th percentile, just out of pure self-preservation, you wouldn't want to be shorting volatility during those periods, right? I mean, I know some people like to play the contrarian, and if volatility spikes really high, you think, well, now's the time I'm going to short the VXX and I'm going to make a bunch of money as it settles back down. I guess what I would tell you is the most dangerous times by far to be short volatility is during those lower levels. So playing the contrarian, while it works most of the time, that punishing time when it doesn't work and it just really doesn't work, it can be extremely costly, and it can cost years of performance. You can take 3-4 years of your success can be wiped out in a week of doing the wrong thing. So most of us know what to do when it's in the high range. Most of us know what to do when it's in the low range. The key to volatility trading and being successful short vol trader over time is what to do in the middle. And as I'm trying to point out with this data, is the middle isn't this mysterious contango backwardation 0% line. It's actually significantly positive. That is still considered middle ground. Contango of 5 or 6% is ambiguous. It's not positive, hey, green light short vol. Contango in the 3 to 7, 3 to 8% is still pretty ambiguous, and you'd want to cross-reference everything you're doing with multiple volatility metrics to make sure that everything is confirming signals before you actually think now's the time to short vol. And that's why I do like percentiles, and I do like to measure everything relative strength to other metrics, relative to itself, relative to history, relative to how the VXX performs, and try to get the best possible strategies going forward. We all have success and failure, hits and misses. I've had my share of misses in the last year because of all the volatility spikes. I can actually show you that right now. There's been several of them. Got a chart here if you're interested. One of the reasons, and maybe you're like me as well, you've had mostly success shorting volatility in the last couple years, but you've had some disappointing days. And if that's the case for you, you're not imagining things. It has actually been that type of environment. There have been, even just this year, you can see these are the largest VXX spikes going back since VIX Futures launched in 2004. And 3 of them have been just through the first 6 months of this year. And actually, the one that happened just a couple weeks ago, that one was, I believe, 14.3. So I think it was about the 34th largest. You can make a case that 4 or 5 of the largest 40 VXX spikes in the last 18 years have been in the last 6 months. So you're not imagining things if you've been basically spinning your wheels. You've had some good periods where you go for several weeks and you're doing well, and then you get hit with one single day and you're back to normal. That didn't typically happen nearly as much in the past. So you're definitely not imagining things if you're a little bit frustrated with the whipsaw action that we are seeing. But point being, it's really what to do in these ambiguous middle ground periods that's going to be your success or your failure. And there can be a massive difference there. It's not like we're trying to squeeze out a few extra percent. This is make or break, this area. We all know what to do now. I mean, I'm not telling anybody what to do. This is not a trade recommendation. But given current levels, there's really no reason why a person wouldn't be short vol now. I mean, if you're not short vol today, I really don't know when you would be. But when things start to deteriorate a little bit, we start going down into this below the green into the red zone here where we're just at the median. What are you going to do then when you're at the long-term median? That's what's going to make or break your success. But moving on, you can see the max min, extremely high. That's why I like to use the median rather than the mean. It can hang out in very low levels during crisis, obviously financial crisis, peak of COVID, March 16th-ish, and all the days surrounding it. It can, it can be very high there. And then this one, again, highlighting the fact that relative value is what matters. Because a lot of times people think contango short vol, backwardation long vol. Totally not the case. We are actually in contango nearly 84% of the time. So again, we've got to default and actually rank what that means. You can't just say, well, it's 2% contango. That's a green light. It is most certainly not. So 84% of the time, this is above, right? We're only dipping into negative ranges 16% of the time. And they are grouped together. We'll see 2-3 weeks straight, and then it might go several months where it's positive. That's totally normal. Contango is the normal state of affairs. So when we look at the original VIX futures curve, while it might not look quite this perfect, where every single future, what I said, full long-term contango, might not always look perfect, but certainly these front two, 84% of the time, they align themselves in this shape where the second month is above the first month. So that in itself means nothing, right? 84% of the time. Doesn't really help whittle down those trade signals for us very much. But yeah, and then this is highlighting the current streak. Obviously, it's been a very good streak in the last year. minus a couple of days here and there. January 27th, we had a massive spike. February 25th, where's our other? There was a third one, just so I get the date right here. Where was that third one? May 12th, VXX spiked 17.45. I believe, what was the date? Don't hold me to this because it's not on this list. July 17th or something like that. That was that one that was 14.3. It would be just off this list. There's actually been several, frustrating little kill shots along the way. But 96%. So another thing that we can highlight, and I always think this is important for people to put into context, because I've been doing this basically trading derivatives and volatility before the volatility ETPs even existed. I was a derivatives trader back to 2005. When these launched, it took probably until about 2016 or 2017 before people really even realized what these products were. As somebody who's been making videos and writing articles, certainly the articles back to 2012, 2013, nobody read them. Nobody knew what I was talking about. Nobody really cared. It took basically late into this stage before the general public even knew what volatility ETPs were. And so that leads a lot of people to be very frustrated with current performance in the last 3 years, because they're wondering, well, why isn't my results matching up with what these, I'm not calling myself one or anything, but these pioneers of the volatility space, how come they were showing such great results, from 2012 to 2017, 18, and now I'm feeling like I'm getting whipsawed every 2 months and I'm losing my money? It's what I call the volatility regime change. If you go on my website, the YouTube channel, if you actually type in volatility regime, I believe the first video that comes up, you can check out this 22-minute video. I go into much more detail. I don't want to do that today. I don't want to waste anybody's time. But you can see here, there's been a clear change with this M1, M2 VIX futures. Before, from January 2011, right up until that day before Volpocalypse on February 5th, 2018, it was averaging 6.72. Since then, we're averaging 4.86. And this number was actually in the threes just a couple months ago. It is this current streak that's pushing this back a little bit closer. But basically, volatility has been elevated for a very long time. You can see it on a VIX chart too. Not saying I particularly like the VIX. I actually don't use the VIX index itself for very much. But we can see that while it's definitely lower than it was during the COVID years, it has not settled back down into the lower ranges. We are in an elevated volatility range, for sure. That's just where we are, and that's this volatility regime change, where the past 3 years, it's been a lot of whipsaw. You certainly expect lower performance than what we call these golden years back then, right? This concentration of extremely high, consistent contango that we saw for about 6 years, minus the odd crisis here and there. It's just not the case anymore. Volatility trading has become much more difficult. And again, it's difficult in that range. It's not difficult above 70. Everybody knows what to do. It's not difficult below 30. Below 5 gets a little bit dicey. Are you going to go long vol? Are you going to risk that whipsaw? I personally do about 3% of the time, but gets a little dicey down there. But this is really the area where you want to focus all your efforts on. We're all short vol today. I would assume 99% of people watching this stream is short vol today. No big deal. What are we going to do when we start seeing this type of whipsaw action? That's kind of what we're getting at here. So anyway, this is showing the current streak, 96% right now. This is how many percent of days in the last 1 year, 252 trading days in 1 year, 96%. Basically, this entire year minus a few days here and there, we have been in contango. The highest ever back in 2012, of course, there was a streak there where contango lasted a very, very long time. This, 273, we can easily get way over 252 trading days where we are in contango. The lowest ever, 39. So even in the heart of a financial crisis, you can still expect 40% of the days are going to be in contango. That's why I say this alignment, M2 over M1, it's just not a good indication of how your actual trades should be aligned. You can expect Contango is the normal state of affairs. Even in the worst of the worst period ever, we still saw almost 40%. So just keep that in mind. And then this last chart here, this is just showing what I was talking about. This is the last 252 days, M1, M2 VIX futures. Here's the 132-day streak we are on. This is January 27th right there. It was just one single day. And then 57 days before that, it was in Contango. And then a little stint right there. And then another 40 or so days before that. So most of the time, the VIX futures have actually aligned themselves in that Contango orientation. So we're in one of those stages where, look, you're going to have to obviously figure out. If we look at this, it's pretty clear. We are now seeing the first streak in quite a while. Are you the type of person that believes this is going to continue? Are we going to see some of this? Some of this, maybe? Who knows? Can the Fed really engineer this market to the point where we see 4 or 5 really good Contango streaks for several years? Are we going to re-enter a golden year era of the short vol trade? Or is it going to continue being as frustrating as it has been over the last, I would say 1 year, but to be honest, it's been about 3. It's been since Volpocalypse. We had Volpocalypse in Q4 2018, where I don't think anybody should have been short vol that day. I'm not saying that day was costly. You should have been in cash. But that middle ground lasted for a long time, and there was a lot of whipsaw. And then it wasn't that long. Then we got the Q4 2018 crash, and that took a long time to settle itself. Even well after that, there were spikes and little aftershocks and tremors. So, not a very easy market to navigate. You can definitely forgive yourself if you're not completely thrilled with your short vol performance in the last 3 years. I wouldn't beat yourself up too much. It actually has been a pretty decent whipsaw environment. So my advice to everybody would be to focus in on that middle ambiguous ground. I know if you go on Twitter today, you're going to see a lot of people talking about how easy it is to short vol. This is just the simplest. It's just like an ATM machine. It's money falls from the sky, right? Look at the Contango. Look at it just short everything, right? Short vol. Okay, everybody knows that, right? Everybody today knows what to do. People start to get pretty quiet when it gets into that middle ground where nobody really knows what to do. Risk gets elevated. That's when the big trouble days start to arise. What are you going to do then? So as I pointed out with this data, that's why we go through these, deep dives of relative strength of the past. You got to have a plan, right? Because it's not going to stay where it is now forever. So just know that we will be bouncing around between good periods and bad periods. So be aware that for all those people on Twitter, for everybody who's going to tell you that short vol is an ATM machine and it's free money, remember that exists only on Twitter. Nobody who manages a single dollar of capital for other people would ever utter those words. So that's the first thing. Second, you'll never see a track record of any of those people. And the short vol trade, I assure you, is not free money. It is very difficult, and you really want to hone in on that ambiguous middle ground. That's best return on capital is going to be performing well during those periods. So, of course, pause the video on any of those charts that I put up there. Useful data for you to just keep in mind. A lot of times people will tell you what Contango is, but you really need to know what relative to other things. What's the 30th percentile of M1, M2 Contango? Stuff like that. So let me get into some of these questions. I would imagine there's going to be several about what we just talked about, but you can ask anything, honestly, anything. We just did for anybody who didn't see it. Actually, you know what? I missed. Sorry about that. This is new as well. This segment here that I'm calling Hot Off the Press. This is essentially just what I'm going to do, highlighting anything that I've done recently that since the last live stream. So I should probably highlight that now. So we'll do that little segment for this live stream that we did, the previous one. You can see in this little thumbnail, I think I'm drinking there. The reason I'm drinking wine and not coffee is this was a completely off-topic Q&A. The rule was no business, no VXX, no VXY questions, off topic only. And I managed to make it through, what is it, a 2-hour live stream. Didn't get myself canceled, didn't say anything too embarrassing, but we talked about religion, politics, relationships, traveling the world, all kinds of stuff, golf, boats, stuff like that. So that was the last stream we did. That was when I was sitting in Panama. This one here, I do want to highlight. This rent versus buy, this was just a straight up video that I made. It's not a live stream. Basically weighing the difference between renting your home versus buying your home. And I do want everybody on this stream to go back and check this one out, because what I'm going to do... What am I doing? I wasn't even on screen share that entire time. I'm sorry. Literally every stream, at some point in the 2 hours or hour, I will do that. So I'm an idiot. What can I say? I'm terrible at this. This is the off-topic live stream, so go ahead and check that out. But this video here, it's the most recent video. Check this one out, because what I'm going to do... In that video, I had a spreadsheet, and I basically analyzed my current decision, whether the reason I'm renting a home in Taiwan and not buying a home is because I went through all the calculations, and renting in that country is actually better for me. It varies wildly depending on what country you're from, where you live, what your rate of return is, what your credit rating is. Tons of variables involved. So what I'm planning on doing is making a much more generic spreadsheet that everybody can download. And then we'll do another live stream in the future where you can download your spreadsheet, and really live together, we can all input our values. And at the end of it, you can see whether you, in your city, your situation, your level of investing prowess, whether you should be renting your home or buying it. So I thought that would be a fun live stream to do. So make sure you check out that video first. I understand it's a hot button subject because most people own their homes. They think renting is flushing money down the toilet. In some cities it is. In some cities it is absolutely the opposite. It's actually better. But that's really all we've done since the last live stream. So catch up on that one, and then stay tuned for a future rent versus buy, sort of an interactive live stream. That'll be kind of fun. All right, enough babbling. I went through all that. Let's open it up to some questions. So, as always, apologies if your question is missed. There's always way more than I can get to. But let me try to speak as succinctly as I can. So first one, Marcelo or Marcello, probably Marcello. You do your trades market on close, and so do I. But I notice that it's sometimes bad execution on option MOC trades. Do you also do options MOC? What is your opinion on market on close trades for options? So as a general rule, market on close, don't ever execute any option trades with market orders, because the bid-ask spread on options is going to be significantly more than all of the other ETFs that we trade. So if I'm doing the SPY or the MDY or the Qs, these are all penny. There's no reason why you can't do a market order. I always execute my trades at market close. Several reasons for that, of course. I just like to be consistent. I also don't like to front run anything. That's a huge problem in the investment industry where, people send out signals and then they front run it. Then they tell everybody, and of course it's beneficial. So I take my trades a good, 4 or 5 hours after I send the trade signals out. I think that's important. But really it's just choosing a time of day. So you can choose any time of day. You don't have to do market on close or close. But options, don't ever trade market orders in general. You want to do limit orders, target that mid price. You might not always get it, but everything that we personally trade within the VTS community, highly liquid, VXX, or if we're doing stocks or ETFs, they're always the most liquid. Should get the mid price quite easily, but you can always just go for the mid, and then if you don't get it, move it a penny and sit there for 30 seconds, try to get it. Don't have to nickel and dime. You don't have to wait for an hour, just 30 seconds. But yeah, limit orders only on options. No matter what, across the board. Don't do market orders on options. Very, very high likelihood that you will be paying much closer to the bad end of that bid-ask spread. Okay, Michelle, I believe, looks like that's how, sorry, apologies for pronunciations, but Have you checked VXZ as a ZIV replacement? What about replicating ZIV manually with futures? We'd need a trade per day. Yeah. So good questions. This is more specific to the VTS options or the VTS community itself. But VXZ is the long volatility version of the M4 to M7 VIX futures. It was my old absolute favorite volatility ETP. So I went through what Contango was with the M1, M2. Reason I focused here is VXX, VIXY, they're materially identical ETFs, 1 times long. You got the UVXY, 1.5 times long. That was deleveraged on February 27th, 2018. And then you've got the SVXY, which is an inverse product, 0.5. But all of those are here. ZIV was these 4, M4 to M7. This section of the curve moves slower, right? This front month especially can move violently very quickly. Of course, it's a short-dated contract. It takes a lot more to move this middle part of the curve. So I actually liked the ZIV. It was an inverse M4 to M7. This question is getting at the fact that VXZ is M4 to M7 on the long side. So it's essentially the same thing as VXX, just on the M4 to M7. Volume is horrendous, so it's probably just out as far as trading goes. You could look at the VIXM, but volume-wise, no. That's basically the main reason why we don't use it. And what about replicating ZIV manually with futures? So you could do this. I could do this. Using, like you said, you'd need a trade per day. The reason the volatility ETPs function so well is because they're rebalancing every day and they are able to follow a set methodology. So there would be nothing stopping us individuals from replicating either the VXX, the UVXY, same leverage and all that, ZIV, but it's very involved. I mean, you've got the ready-made product right there. There's no chance that I could replicate ZIV for a community of people. It's just, not only just trading futures itself requires additional permissions from people, and it would be a nightmare. Everybody has to go to their broker and ask for the proper permission, and a lot of people wouldn't get it. And then people are trading in IRA accounts, and that's going to be a nightmare, or whatever tax sheltered account in your country. We've got members from 67 countries, I believe now. It's just impossible. Can't be done. So, I mean, I suppose with a lot of work, a lot of heavy lifting, I could do it myself for my own account. But even then, I don't want to do that. It's just, it would be very involved. So unfortunately, we are all subject to the ETFs that we have access to. And right now, M1, M2, front month futures. I hope, and anybody listening, if there's any asset managers that are going to at some point listen to this, please, please consider a middle of the curve. Doesn't have to be M4 to M7, but give us something like M2 to M5. Bring something back. And while I'm a tiny little fish in a big ocean here, I will do my very best to market it and make sure that it has a little bit more exposure than the previous one, because the ZIV got no love. VXZ gets no love. It just doesn't. People, for whatever reason, people like the fast-moving, big, exciting, could go up, could crash quick. They just like that more. I don't know why. Midterm futures are probably better long-term, but it is what it is. So that's a long way of saying no, it's totally not feasible to do that. Sorry, I wish it was. Can you explain the term cash VIX? Not only do you not pay cash for it, it's not even for sale. Well, essentially, you answered the question in there. So the cash VIX, the reason why I call it the cash VIX is because the VIX itself is a cash-settled index. So this is the VIX right there, the 1 month. We all know that. This methodology, this is not a tradable product. You can't own the VIX, and all options are cash-settled. The VIX is not an ownable product. That's why I call it the cash VIX or the spot VIX, either or. But the VIX index, that methodology, basically a 30-day contract of the S&P 500 options activity, that can also be used the same methodology for a 9-day. So that's the VIX 90. That's the VIX 3M, basically a 93-day. VIX 6M, VIX 1Y. The same VIX, cash VIX or spot VIX, we have an entire curve here for all of them, of all different maturities. So much like we see with the VIX futures, right? with this shape, we are also looking for a contango shape in the cash VIX term structure. You can call it whatever you want. It's not like this is some formalized, lingo or anything. This is just what I call it. The cash VIX, the cash VIX 9D. You can't own these. There's no underlying to buy here. So that's essentially what it is. But like I said, I will probably, like today was just M1, M2 for this live stream. We could do 20, and I haven't even shown even half of my volatility metrics yet. We could do live streams from now until next year, breaking down all of these. And I think I will. I'll highlight one sort of every couple of live streams, and we'll do a deeper dive into all of them. Like I showed you my, this is for M1, M2. We can see all the data here. Which way am I going? But we've got spreadsheets. We can go through the VX30 to VIX roll yield. I've got, the VRP. We could talk about that, the difference between the implied and historical volatility. We've got tons of volatility metrics that we could go through. I've got the complex ones that I calculate myself. We've got correlations and beta. I could go through this. I mean, how long do you want to be watching my live streams for? Come back, subscribe to the channel. Maybe this is a time when I can say, don't forget to like and subscribe and come back for more, because I've got dozens and dozens of metrics that we could do those deep dives for. The VIX futures themselves are the least beneficial ones that we can really look at, or among, it's just entry-level stuff. So we're starting today, and we'll get into it. Cash VIX will be coming. That term structure, very, very useful for trading, especially if you're a volatility trader. You definitely want to focus on that. Okay, another one I will not try to pronounce. Apologies. Could you give us a summary of what and when will be made the changes of the tactical volatility strategy? Aren't you worried that those adjustments could be affected by overfitting? So tactical volatility is undergoing no changes at all. Apologies for anybody who's not in our community, but we are currently undergoing changes in the VB threshold strategy. So before, there was another section here. There was a short vol area and then an S&P 500 area. I've just made it all S&P, and in the leveraged version, I've made it all double S&P, SSO, while I go through the process of making some adjustments, because this strategy actually has not performed up to, sorry, my screen is hiding, so you're going to see some movements here. How am I going to actually show this? It's on my desktop here. There's a picture that I want to double click, but I can't. The VB threshold strategy has not performed up to my expectations in the last few years. It used to be a rock star. It has, the short vol trade itself has become extremely difficult in the last few years, and it has not done well. I mean, let's just be honest. It's been holding the portfolio back. So these are where the changes are going to be made. You mentioned tactical vol. Nothing's happening here. There's nothing wrong with it. This strategy's been in my portfolio since I launched VTS in January 2012, and I've been trading it even before that. So it has never left the portfolio in 10 years, aside from a few months during Volpocalypse, where we actually lost the XIV. We had to move over into VXX options. But nothing's there. It's all here, VB threshold. So I will be going through the, slow, relatively meticulous process of making the changes that I need so that strategy performs hopefully back up to expectations. As far as the second part, that's a really, really good question about curve fitting. Whenever you're making back tests, like I could make a back test right now for all of my strategies, make a few little adjustments here and there, and I could make the charts look absolutely insane. But that wouldn't be live trading. That would just be me optimizing the performance of a back test. Given full 2020 hindsight, I know what happened. So I can just make a little tweak and say, well, I could adjust my thresholds so it allows me to be short vol a little bit more during 2017, for example. It allows me to be long vol a little more during 2020. And I could make the back test just look ridiculous. That's not what I'm going to do with this thing. I have been live trading for 15 years. And also, just beyond that, the portfolios that I show on the website, while the individual strategies can change, and some of the individual strategies are back tests, like if you go into the individual, let's say this one here, This is the leveraged tactical. I should be using the unleveraged tactical. Sorry, apologies. Do the unleveraged tactical balanced. This strategy launched right here, right about here, live, January 2012. All of this is live trading. Before that, let me see if I can't. This section, you can just imagine. Hopefully you can see my cursor. This section here is a back test, right? Everything before January 2012 is a back test. But everything I show on the website with respect to the actual portfolio, the total portfolio, this is 100% live trading. None of this was changed, backfilled, no survivorship bias of any kind. This is literally what a person would have gotten if they just followed every trade signal from the actual emails. This will never change. So you'll come back 20 years from now, and this chart will look the same during this period. I'm never going to go back and change that. This can't be changed. This was the community put their money into this portfolio, so this can never be changed. Individual strategies do undergo changes because markets do change, right? So I'm going to have to go back through this strategy, figure out how to realign the strategy essentially. And the problem area is the short vol area. I'll just tell you that right now. There's nothing wrong with the stocks, the bonds, even the long vol section of that strategy. It's all great. The problem is the short vol area. We are too exposed to short vol on the low end. And as we've seen, there's a volatility regime change. We're not seeing that low end. So I actually have that strategy geared to be more aggressive on the low end. And it's introducing whipsaw in the middle. Right around that 40% level on my volatility barometer, we are seeing in the last 3 years, that's kind of, right about here, that's kind of, you can see there's a lot of action around that area. And this is why it has been frustrating for that specific strategy. Whereas before, if you can imagine what used to happen for the first, 6-7 years of our portfolio, it used to dip down and the action actually happened closer to 20 or 30. So that strategy, which used to perform exceptionally well at that 20 to 40% range, has not. I mean, clearly that 40% level is in this new volatility regime. That's a trouble area. These other strategies don't really suffer from it as much. Of course, we can remain in the queues all the way up to, 65. We can remain in stocks. So there's no real whipsaw here. That's why when you look at my strategies, they don't look like they're doing poorly. They're actually doing extremely well because there's no whipsaw, right? A couple of the other strategies that we have, live trading, they're doing great. No problems at all. When you look at VB threshold, because of where that is happening, it needs to be changed. It just does. And that's part of the investing process. Nothing works forever. You don't just build a strategy in, 8 years ago and then just cruise control until the end of time. Markets change, and it's kind of a balancing act between when do you make changes. I've been aware of the underperformance for a while. It's been underperforming for a year. But you don't jump in and make a change after a 2-month bad period. All strategies suffer losses. They all go through drawdowns, and they all go through times where it just seems like everything you do is wrong. On the flip side, they also go through periods where everything you do is right, and it's a lot of fun. But trying to balance that fine line between when does it actually have to be changed and when is it just a bad period that will end. That's what, as a risk manager, that is what I do. And I have determined, pretty clearly the VB threshold needs changes. So give me some time. For the time being, we're just going to stay in stocks in a pretty big, wide range, and I don't imagine there's going to be a whole lot of whipsaw there. Doesn't mean it's going to be profitable. Hopefully it is, obviously. But we're trying to reduce that whipsaw. And that 30 to 50% range is problematic in the last few years. Hopefully there was some answer somewhere in that. But yeah, VB threshold is under construction right now. Okay. What bear market indicators have you explored? Popular or promising but lesser known ones? And can you explore one or two of the most effective ones? Bear market indicators. So what are you trying to get at? Well, the one thing I can say is I use volatility metrics exclusively in my trading. A whole laundry list of volatility metrics. So if you're asking me things outside of that, fundamental indicators or RSIs or Bollinger Bands or whatever, these things people use for their trading, I don't use any of that. So you could say that for me personally, I use the same stuff. I mean, we'll just focus on the volatility barometer. It's basically my own index that I created that includes, many, many metrics inside it. This is the indicator that I use. So bear market, I don't know, bear market technically are you talking about stocks crashing 20%, the old standard bear market definition? Or are you just saying risk off, time to perhaps start going long vol? My volatility barometer tells me that. Over 80%, you can see the strategies down here, VB threshold. Over 80%, we're going to start going long vol. Over 60%, we're going to exit to safety bonds because at that point, it's too risky to hold stocks, way too risky to be short vol. So there's a band of safety and then a flip point where we can actually try to get aggressive. Same thing with tactical vol. It's a little bit higher. Same thing with aggressive vol, a little bit higher. But I would say, in general, the same metrics that I use to short vol, I will also use in a much narrower band and a much tighter tolerance to go long vol, or to, as you put it, as a bear market indicator. Now, bear market to me implies an extended period of bad performance. For that, we just have to wait and see. My volatility barometer can go over 80 and stay there for a month. So I suppose that's what you're asking. But for me, yeah, if you're looking for what we covered today, just to tie it into what we went over today, where is our... This is what we were talking about today. M1, M2 VIX futures, just our basic front 2 months. Well, 5th percentile, this is when the VIX futures are obviously demonstrating significantly low values, right? Minus 5.67. There's only been 5% of days in the last 17 years where Contango, right, the front 2 months, has been below minus 5.67. So as a bear market indicator, that's a pretty good sign right there that something's wrong. I'm not saying that that would lead to a certain trade decision on your part, but that would certainly tell you that something is, relative to itself, demonstrating some extreme levels. Obviously above, 5% below, whatever your level is. Personally, my tactical volatility strategy has been long vol, I think about 2.8% of trading days since 2012. So it's a pretty fine threshold there on the aggressive long vol side. The long vol is a notoriously difficult trade to handle because even if you get it right, let's say you got the COVID period and you timed it and you made a bunch of money, what ends up happening is you end up giving a significant amount back because the markets will at some point recover. And the same signals that got you into the long vol position tend to keep you in it for a little bit too long. So it's a problem to solve. It's a significant problem to solve. But yeah, I would say that same signals, high and low, just a much, much smaller band on the high. You don't want to be long vol 20 or 30% of the time. Believe me, you're going to lose. You're going to just bleed capital for months doing that. And you'll have a couple of good days, but no, you want to narrow that band significantly. That's another reason why there's some of these tail fund strategies. I just think they don't make any sense. I understand that they have rules and regulations, and they have to try to stick to what sells for their clientele. But the entire concept of a tail fund strategy doesn't make any sense to me because we know for a fact that 90% of the time it's going to suck. So why would you just hold this thing and just sustain month-long losses in order to try to pick up a few pennies when you get the spike? Why not apply the knowledge that we have, that I'm sure they have as well? The fund manager knows that most of the time their fund's going to be going down. You can't be a little bit tactical. I mean, you can't just try to filter through a little bit of the noise. I don't understand it. So it's just one of my little pet peeves that a lot of people who talk about long vol, and I'm sure you know the usual names and the usual crowd. You look at the results, and it's just like, who would want that? For every month-long success period, you get 11 months of failure. I don't understand. That doesn't make sense to me. Okay, this is interesting. Are the VIX futures really freely traded? Yes, they are. Or do they limited number of large players have unique influence on pricing? Well, if that was the case, I mean, even if there was one player, let's say there was one massive player that was, multiple millions, hundreds of millions of dollars, just them and nobody else is playing, that's still a freely traded market. There's nothing saying you can't go in and trade with them. So I'm certainly not suggesting that it is just completely distributed evenly across the board. I would imagine there are some players that are pretty significant in the volume of the VIX futures. That doesn't mean it's not freely traded. It is still, you right now can go trade whatever futures you want. And that's, to me, a freely traded, I should use this term loosely because we'd need to dive deeper, but non-manipulated market. Don't start exercising the thumbs down button. I know a lot of people think these markets are manipulated. They're not really. They are freely traded markets. Doesn't mean you can't move them in the direction you want, but as long as it's open for everybody, I consider that freely traded. It's not Goldman Sachs' fault that I only have a limited amount of capital. We both have access to the same markets. Are they bigger than me? Yeah, of course. They can drown me out completely. But that doesn't mean that I'm not free to do what I want. So, and it's the same thing as trading the market that's in front of you. I always just, no complaining, no pointing fingers, no, hey, this is not fair, this is manipulated. No, we're all adults here. That is not constructive. I'm allowed to do what I'm going to do, and I have to make sure that I'm doing it correctly. Even if other people have larger influence, I still have to get my trades in. So it is a freely traded market, in my mind. Moving along. I think this is a continuation. I should have looked. I believe the kink we typically see in January is due to the psychological aspect of buying long-dated derivatives in the next year. It's not a January thing. I understand that it probably appears that way now because there's the December, here's the January. But you got to remember, like during an election cycle, for example, the kink will be in November. During any type of huge, several months in advance binary event, the kink can happen anywhere. And of course, the kink will just track down as those dates get closer. So I would be a little bit careful to think there's any difference between January and December. Long term, I don't think, even if that was the case, it would be a very, very small difference. And I don't think it would help your trading. So not calling you, I'm not saying you're wrong. I'm just saying I don't think data would support that. And even if it did, I don't think that it's meaningful in our trading. I haven't noticed any seasonality that is on a significant level. There might be small, but it's more statistical just because we've got a data set that is very, very small. I mean, it might sound like 17 years. That's a long time. It's a pretty small data set. As far as statistics go, that's a small sample size still. So got to be careful drawing seasonality conclusions here. Okay, bonus question. I think you asked one from before, didn't you? Yeah, you asked about the VB overfitting. Bonus question. Okay, here we go. Do any of your metrics ever take into account SKEW? No, I hate the SKEW index. This is one of the things, if you go on Twitter, sort of like a lot of people will post the SKEW index, especially recently because it was at extreme levels. And then you'll get people who either like the SKEW or hate the SKEW. I'm on the I don't even look at the SKEW index. I think it's structured poorly. If you want to kind of know SKEW, like one thing that I do, which is very helpful for me in my options trading, especially strike selection and deciding what type of options to trade, just as a basic example, the VIX index minus the volley index, I calculate this every day for the community. The VIX index is we know what the VIX index is. It's a 30-day measurement of S&P 500 options activity. But the VIX index is all strikes, right? It's a composition of several strikes at different in the money, out of the money. Whereas the volley is a similar index, But the volley uses SPY, first of all, but importantly, it uses at-the-money strikes only. So the VIX minus volley is essentially the residual of out-of-the-money options activity. So I use my VIX minus volley to determine, for example, should you be selling a straddle or a strangle? Right? If you're selling a straddle, you're selling at-the-money premium. If you're selling a strangle, it's essentially the same trade from a risk-reward perspective, but now you're selling the wings. You're selling both a long, an out-of-the-money put and an out-of-the-money call as a strangle. There will be a time, depending on this residual, whether you would collect more premium in the middle on that straddle, as opposed to a time when you might want to sell the premium on the outside because maybe out-of-the-money activity is where the premium is at. So I think that's what you're getting at. And this is how I personally solve the problem. But if you're not a member of the community, another thing you can look into is an index called SDEX, and then another one called TDEX. This is the nation's, basically it's measuring a 3 standard deviation out of the money options activity. So the TDEX, I believe, is going to be much more useful for you than the SKEW. The SKEW has just structural problems with the way that it's built, and it doesn't actually end up measuring what it is intending to measure. So for the VTS community, we do the VIX minus volley just to get an idea of what's happening out of the money on that premium. But you could also use the SDEX, TDEX, and look under the nation's indexes. They are structured, in my opinion, much better. And in fact, volley is better than the VIX. It's just that the VIX is the brand name and volley is fairly new. A lot of people don't even know what the volley is, but VIX uses the SPX options of all strikes, and the volley uses at-the-money SPY option strikes. I mean, I'm not telling you right or wrong, but which one do you think is more meaningful from an actual trader perspective? I would default, 70, 80% of the time saying that the volley is actually more meaningful. But, of course, everybody's free to make their own decisions. But, hello, Vanessa. Checking out my live streams. Probably doesn't know what I'm talking about, but thank you for popping in. Okay, so Ilya, well, short vol has been going a bit sideways the past month or so. Yeah, it's been good stretches, and then as you know, you manage a short vol strategy as well. I would imagine you have been hit by the same frustrating one-day spikes as I have. It's just, what do you do? That's what we're all trying to figure out. We all know what to do today. Hey, if you're not short vol today, I don't think you ever will be. And we all know what to do when the markets are melting down. Get out, move to safety. It's what we do in the middle that defines our long-term success. And that's why I call myself a risk manager, not a trader or a fund manager. And there have been some vol spikes last year. Yeah, January 27th, February 25th. For anybody who's kind of just popping in now, I can actually show you when those spikes were. You can sort of come back and pause this if you're interested in that information. But yeah, these are big VXX spikes. So if you're a person who's closer to the 1x leverage factor, those are very frustrating days. For me personally, our tactical volatility strategy uses VXX options, typically about 0.5 or 0.6 delta, so we're not fully exposed to VXX, maybe 0.6, but they're still, lose 10% in a day. When that happens, you get hit hard and it sucks, Thankfully, we're not in it during these periods. Like I said, most people, March 16th was the worst day ever. I certainly hope nobody was short vol on that day, but yeah, you are not wrong. There have been some very, very frustrating vol spikes. I remember, I remember this website as well. I remember because Volatility Made Simple blogged about my strategy. Interesting. They actually highlighted yours. He, whoever he is, one of them, I think there was 2 of them, contacted me to highlight my strategy, and I said no. Simply because I think I can say this because I think he went out of business 6 years ago, so I don't think I'm stepping on too many toes here. I think he's long gone. but I don't think he was fair in judging all of the people's strategies. I don't think he really knew what he was looking at. And I think the performance, what he showed himself with his own strategy, I think he was very heavily looking at the VRP. And back then, a lot of people thought that measuring the difference between the implied and historical volatility was the key signal to solving the short vol riddle, so to speak. I think he missed big time on that. I actually wrote side tangent. This was ages ago. I'm sorry. I'm going back into the archives here. And I've got hundreds of articles that I didn't even upload. I transferred over I used to use WordPress, and then now I use Wix.com. And it's just a pain in the butt to transfer everything. But let me go to my older. Yeah, like this is back in 2013. So I wrote these 8 years ago. Let's go into this one, VRP. I sort of explained what it is, like trading based on the volatility risk premium, and how it doesn't really work very well. Like this is kind of when it started to fail in around 2014-15. It really started to fail. So that's not a very good signal. I know I even mentioned it. Where is the... Sorry. This is a blast, trip down memory lane for me. Volatility 3 years later. When was this written? I know I mentioned them in here. Anyway, yeah. What he's getting at is there used to be a website years ago. I don't think I've seen it since 2014. But what he did was he would just take other people's methodology and track it on his own website. So apparently you were highlighted there. I told him no. I don't think he knew what he was looking at. So I didn't want somebody else judging mine. So I didn't give him the information. But cool. You were on there. Interesting. I remember he had at one point, sort of at the peak of the website, he had a good 30 or so. Remember like the brute force strategy and the the market size strategy, and yeah, there was a bunch. I'm sure Bill Luby's was in there somewhere, the Vixen Moore, which he's still around. I always recommend people follow Bill Luby. He's definitely a pioneer. I think his was in there. Good stuff. Trip down memory lane. You've been doing this a long time as well. That was like 7-8 years ago. Okay, for annual subscribers, do we trade both vol trend and overlay or just overlay? So just 2-minute tangent for everybody who's in our community. You trade them both. Right now we are in the standard vol trend is this one here. So this is the standard short VXX put that we have right now at the 27.50 strike price. This is our tactical volatility position. This is a long December. This is just stock replacement. As I said before, sort of tracking the VXX at a little bit lower. But this one, let me highlight this one. That trade is our vol trend overlay. This is a broken wing butterfly, 30, 29, 27 broken wing butterfly. This is on as well, right? These are all live trades. So these four, this one, and then the butterfly, they go hand in hand. Essentially, as I'm sure you're aware, we have both leveraged and unleveraged strategies. So vol trend is unleveraged. And then in the leveraged section, that's where we start trading the 2x ETFs, the more aggressive vol strategy, the SSO, the QLD. Vol trend is not leveraged here. It's the same vol trend. The overlay community is basically the leveraged version of this. And it's a private community for annual subscribers simply because there are some unique risks, and I don't like introducing things that it's one of those, it's very few strategies I have trouble explaining it to the point where people are sufficiently scared about taking on the leverage, because when I explain selling VXX puts, a lot of times people get really excited about it and they start selling it in too high allocations. So I wanted to make sure I'm not actually cheerleading something that can get people in trouble. So it's a private community. But yes, short answer, you trade them both. Do you recommend to split our investments between That's a good one. Interesting. Do you recommend to split our investments between several different brokers in case one goes bankrupt? I can't tell anybody what to do, but when you reach a certain level, right, all your accounts are protected by, there's insurance on that. There's, whether it's $250,000, whether it's $1 million, depending on the structure of that account, you will have some protection there. But when you start getting a significant amount of capital, you start to worry about the credit risk of the actual banks and the issuers of the ETFs that we trade and whatnot. At that point, based on your own comfort level, I wouldn't say there's anything wrong with spreading out the risk, having several brokerage accounts. Nothing wrong with that. I have 3. Yeah, go ahead. I don't see anything wrong with that. But a lot of your accounts will have ways that you a recourse to get some money back, probably, or protect your money. I don't get into stuff like that because we've got so many people from different countries, 67 countries, like I said. Stupid question alert. If you hold a long VIX futures trade longer than a month, how is that time decay? Well, I mean, it's long vol, right? The futures, options, volatility, ETPs, S&P 500 options, whatever you're trading, when you're long vol, you are essentially long vega, and there is a decay factor. So more than a month, how much is that time decay? All? Like, it's, if you hold a call option and it doesn't get to your strike and you hold it till expiration, well, you just lost 100% of your money. So, yeah, I don't think that's a stupid question. It's just, it is what it is. When you're holding a long vega trade, it has to get to your strike or whatever you purchased for a future, the future value, plus the premium that you paid. So for options, you have to clear that hurdle above and beyond that break-even point. I mean, obviously it's probably easier to do it with options. Let's say you were doing a VXX. You can very easily visualize an option, right? So if you were to buy, I don't know, you think that there's going to be a volatility spike, pretty easy to visualize a VXX option here, right? Here's the price right now. So I'm at break even if I open this trade right there, because all we're looking at is the pink line, the daily profit curve. But in order for me to be profitable, the VXX has to go from where it currently is at 28.50 all the way up to 32.78 just to break even, because there's a big premium there, right? So not only did I buy the 32 strike, but I also have to clear that little hurdle as well for the premium I paid. So yeah, it's a long vega position. You can see the vega here, positive vega. That's going to decay every single day. There's going to be theta decay, negative. I'm going to lose 786 a day holding this contract. And that will ramp up exponentially as we approach expiration. So I think that's what you're asking, is what happens when you hold long vol and it doesn't go in your favor? You lose all your money. That's what happens. Obviously, that's not the case for things like VXX, but there is decay every single day. Okay, I think you're answering someone else's question that I almost certainly missed, but I would say that does he mean me? I would never short VXX call, as that is totally undefined risk. Yeah, no. If you mean me, you're absolutely right. I would never sell a naked VXX call. That would be... I have multiple live streams and videos and articles talking about this, but I always just equate it to, like, if there's a flash crash, your trade is over. Are you going to sell a call thinking that you're the person who knows when there's not going to be a flash crash? No, right? We don't know when black swan events are going to happen. Nobody does. If you think you do, I've got bad news for you. You don't know what's going to happen. So to put yourself on the line with an unlimited loss trade that can go hundreds or maybe even 1,000% against you in the blink of an eye, if there's some type of cyber attack or some type of flash crash or chemical, God forbid, chemical attack in New York, fill in your crisis. You know when that's going to happen? I don't. So I don't do things like that. I just don't do it. I always equate that to, you see people on Twitter talking about it all the time, like they're making all this money selling naked premium. No, they're not. These are tiny amounts of money people are putting into these trades. They pretend they're millionaires. They are not. They have regular 9-to-5 jobs. I guarantee you they're not putting more than a little bit of money in it. Because who does that? I've been building my money for years, and I have 20 more years to go. Whenever you reach a point where you have a significant amount of capital, you will immediately understand that you need to protect it first and grow it second. The order gets flipped if you don't have much money. There's a lot of people out there that are just starting their process. Maybe they've got a small account. They tend to default to grow the money first. I'll eventually figure out how to protect it. I'm long past that flip point, right? And I hope that everybody following me is long past it as well, because I think day one, you should get past it. Protect capital first. Learn to grow capital after that. Start with safety, then add layers of aggressive, let's try to make some money. Short premium is just an ignorant position to take. I mean, I understand it gets a lot of eyeballs on Twitter, but the person who's recommending naked short premium doesn't have any money to protect. If they did, they wouldn't be doing that. People don't do that with their money. People don't work 20 years pouring our time and effort into that. All the sacrifice that goes to building a retirement account is hard, and it takes years and years of a lot of effort. You don't say, oh, there's not going to be a flash crash next week. I'm going to just put it on the line. People don't do that. The people that sell naked premium are not protecting their past, present, or future. They're just not. It's just something you see on Twitter. I guarantee you there is zero volatility traders of any significant following or who manage money for other people or who have significant money themselves. Literally 0% of them are selling naked premium in any capacity whatsoever. I mean, maybe just the tiniest little trade, but no. Hopefully I've got my point across. No, absolutely not. Maybe I'll make another video in the next month or two talking about this again, because there's so many layers to why people shouldn't do this. Goes far beyond that. But yeah, don't listen to people on Twitter who are convincing you that the easy way to make money is to sell highly risky position. That is not. Best way to make money is to not lose money. That's the easiest way to make money long term, is to be safe and consistent and not do something stupid, right? Do more of what works and less of what doesn't, and do that for 20 years, and you'll be just fine. So some of the ETFs we trade give dividend. Is that included in performance? Do you take any consideration to dividend date when trading? That's a very good question. So everything in my performance chart, like I said, it's completely live trading. It takes into account dividends. It takes into account trade fees, commissions, all of that. Everything is included in this. So yes, if there is a dividend, like for example, we sometimes do hold the SPY when there's a dividend, or the TLT with IEF, MDY. These are dividend paying indexes. We don't trade any individual stocks, but yep, we sometimes get that dividend. Zero trade decisions are ever made on my end because of a dividend date. I tactically rotate to the best position regardless of dividend. Is just, hey, if it's a bonus if I happen to be sitting in that ETF. But even if I'm 1 day away from a dividend and my signal says to sell the SPY and move into the TLT, for example, well, then I guess I don't get my SPY dividend, because I'm going to trust my signal and move out of the SPY. Always takes precedent over the dividend. Dividend is just a nice little bonus, but it is included in the performance because the way dividends work, when you get paid a dividend, the stock or the, it's all adjusted, of course. You don't just, if Apple pays a dividend, Apple stock doesn't stay the same and you just get this, free money. It's, my stream quality. It's just another warning said my stream quality sucks. And hopefully I'm still here. Can you still see me? I noticed the, dividends are deducted from the stock price and then the price trades going forward. So dividends are just part of the process. I include it, of course. You could short rebalance VXX every day. You could do this. This is getting back to, could you try to somehow use VXZ? You could. I mean, enormous amount of work, and it wouldn't help me. I'm trying to help 1,000 other people manage their investments as well. So wouldn't help me a bit. But what else have we got? Noah, regarding cash VIX. Maybe I'm too literal. I still don't get it. As you said, you can't own VIX, so why use cash? It's just simply because the word cash VIX is very common. It's just, I mean, I didn't make it up. It's just a lot of people will say either cash VIX or spot VIX. It's just what it is. It's just because it's a cash settled index and you can't own the index. So it's the cash VIX. So it's the cash VIX term structure. You don't have to call it that. You can come up with another name. Like my live streams are called Volatility Barometer because I designed the volatility barometer. So I wanted it to be consistent. But if you want to give me a recommendation, if something jumps off the page and I'm like, that sounds way better than mine, I'll give you credit for it. I'll give you a free lifetime subscription. You can stop paying me and you can just get everything for free. Come up with a better name than cash VIX term structure and you got yourself a seat for life at VTS. All right. Are your strategies entirely systematic? I noticed in some of your videos you allude to using some level of discretion when it comes to interpreting your volatility metrics. Don't know what I said or how I said it, but no, I wouldn't say that. It is 100% systematic, rules-based. I just follow the system. The only discretion that I occasionally use, and it's been very few and far between, is there have been times when I have overridden the signal and moved to safety. I will never override a signal to be more aggressive, but there have been a handful, 4 or 5 times in the last 10 years, where I have overridden the systematic signal and moved to safety. Brexit vote, I exited one position to safety because I thought it was very binary and just didn't want the hassle. Fed meeting, there was one in 2018, very instrumental Fed meeting. I moved to cash for one day. But the big one is COVID, right? On February 28th, I was getting I had 500 emails a day, people panicking. Obviously, it was a pretty rough time. So we moved to safety during the COVID period as well. That was discretionary, overriding the signals. But I will never go the other way. I'll never be like, oh, I'm in safety, but I'd really love to be short vol, so I'm going to override. I would never go that direction. Sometimes I will prefer to just be in cash or safety rather than ride through some type of major event. But they're very few and far between. 99.9% of the time, we are systematic. Not the case for option trading, though. Option trading will always have a discretionary aspect to it. So when I'm trading iron condors, I have a strategy that is fun, has rules, right? This time frame, I'm looking for 45 to 75 days to expiration, for example, looking for roughly 80% probability of success. There are general templates that I follow, but there's always strike selection. There's always little discretion here and there with option trading. But all 4 of our ETF strategies are purely systematic. Would SPY calls be a good way to short VIX spikes, so to speak, given their inverse relationship? No, because I don't like calls in general because it's a long vega trade that has decay. But one thing that I can tell you, if you go to my YouTube channel, what would I have called it? Something to do with UPRO. I know that. 3 times SPY. This one, short VXX versus long 3 times stocks. Check this video out because I'm basically comparing, because VXX and the triple leverage SPY, the UPRO, have a similar beta factor. I went through a bunch of data in this video explaining the difference between them and that actually 3 times stocks performs much better after a volatility spike. When everything's elevated and the VIX futures are in extreme backwardation, getting back to today's little topic earlier, when this is severely downward sloping and negative, and then we would be in extreme ways, like below the 5th percentile, it's negative backwardation. At that time, 3 times long stocks performs much better than short VXX. So there's a lot of people who are always looking for that moment to jump in and short volatility. They think that it's reached some insane level and they want to be a contrarian and jump in and short vol. It's actually more efficient to short vol by going long stocks. So I partially agree with your point here that would long SPY calls be a good way to play that contrarian after a VIX spike? Long stocks is a good way to be the contrarian, better than shorting vol. Remember, short VXX and long 3x stocks is high correlation. They're not the same, but highly correlated. So you're right in the long stock portion. When VIX futures are in backwardation and volatility metrics are looking really ugly, you really don't even want to be a contrarian in short vol. You don't want to jump into the options market and start doing UVXY stuff or VXX stuff. It's really not the time for that. If you're going to do that, do it with vertical spreads, but don't do it with long calls. But yes, you are essentially correct. You want to focus on the stock market. SPY, UPRO. You don't have to go leverage UPRO. You could just go to the SPY. But yeah, that's a good instinct. You'd be better served sticking to the stock market because that decay factor, that daily roll yield, where the VIX futures are highly negative, way below the VIX index, that roll yield is still massively negative. You're going to be fighting a headwind if you jump in and try to short vol at that point. And if you're doing, options trading, stick to defined risk spreads like verticals or butterflies. So, but no long call. For me, I can't tell you what not to do, but I just don't ever trade long calls. Like literally almost never. Okay, Dylan, is it better to select CBOE exchange when trading SPX and VIX or leave it as default mode, which is best on TOS? I don't ever try to reroute anything when I'm trading TOS. I basically just do, I think in IB they just call it smart. In TOS, I don't even know what they call it. I never even go into that. I just route it to wherever it's going. Obviously, you can go in, you can override where you're going to get your trades. I wouldn't mess with that. It's all done with computers, and yeah, I wouldn't mess with that. Finally made a live. Thanks for showing up. Appreciate it. Hopefully it was worth your effort, worth your time. Let's see if the lower gap fills. 1860 pivot for lower here. What does that mean? My first instinct is that you might be no, you're not talking about the VIX. 1860, because that's not the VXX. VXX is way higher than that. What do you mean 1860? Are you talking about the VIX futures? Probably. There you go. Front month VIX future. Okay, pivot point. You're going to lose me when you start talking about stuff like that. That sounds a little bit TA-ish. I'll let that one slide. 1860 pivot point. I really don't like talking about pivot points and stuff like that. I mean, it means nothing. In the context of a volatility complex, absolute numbers mean literally nothing. That's why I went through, sort of painstakingly went through that original spiel about how everything is a relative value compared to other things in the market, compared to other metrics, and certainly compared to itself of the past. Everything should be relative value, percentile rankings, things like that. This related to that. Once you start talking about like a pivot point, 1860 in the VIX futures is certainly not a pivot point for anything. It's just a point in time that means nothing, and 7 days from now it's going to expire and drop off the board completely. So, I mean, what does that even mean? I'm not coming down hard on you or anything, but this contract only has 11 days left, calendar days, and then it's gone. So what do you mean pivot? It's going to go up to 2092 in 1 day. If this expired, there's massive stepping that's going on. That's why I also in my volatility dashboard, we differentiate between the standard M1 futures and the standard M1 to VIX, which is just a step process. When it expires, it's gone, and there's a massive, could be a 2-point jump in what you're looking at. So we also go through adjusted M1 to make it smooth. We go through the VXX crush level, which takes into account expiration days. If you're just looking at a front month absolute value 1860 point in time? Obviously, this is a super abbreviated question that, I'm drawing conclusions that you may not even reach, but that seems to be a very arbitrary level. It certainly changes radically. I mean, it could go, it could jump to 20, and that's a good thing for the short vol trade. I mean, if it expires and goes up and the next month is way higher, it doesn't mean anything. That point means nothing. 1860, what's the percentile rank compared to itself of the past? That's what I would be interested in. 1860, okay, adjust that, smooth it out, adjust and account and deduct for the days to expiration, make it an adjusted smooth performance for the VX30, and then tell me where that is percentile rank compared to itself. That might be meaningful. But the actual M1 at 1860, just a point in time, arbitrary number. Panama question. What was the business you were doing in Panama? I don't mind talking about it. We talked about it when I was drinking my wine in my last live stream. I just got a residency, so I'm not, don't have to use it, but I just like to get potential second residencies in case you want to live somewhere else. And usually those processes take a while to finalize. So I'm now, if I want to be, a permanent resident of Panama, which is kind of cool. Didn't love living in Panama, but there's definitely some benefits to being a resident in Panama. So that's what it was. I don't have my wallet here, but I have a permanent residency card. That's what the point of it was. Might do Dubai next. I've always hinted towards that. That's a pretty good back pocket residency to have for people. So I will go through the process first. I'm a chef that eats his own cooking. So my trading strategies, the only reason I say this trade is because it's being done in my own account, and then I pass on the information. So I will do the Dubai process, and then I'll pass on the information. I'll share that. I'm an open book, but I will only speak on what I actually know or actually have experience on. And with respect to trading, where my actual money is allocated. I'll never, it's all based on personal experience. So give me some time and I'll update you on that other one. What else have we got? How long have we been going? We should cut this. One more question. Hour 37. If you don't mind, two things, interrupt, and then I'll do maybe one or two more questions. But first, hate asking. Hit that like button. Should have more engagement than that. We've got 50 likes, and there was definitely way more than 50 people here. So give it a like. And the second thing, where is it here? Twitter. Follow me on Twitter. The only really two places that I really have any presence is YouTube and Twitter. So follow me on Twitter. I have more YouTube followers than I have Twitter followers, which is odd. It's usually about a 10-to-1 ratio. Getting followers on YouTube is infinitely harder than getting followers on Twitter. Twitter's a breeze. YouTube's tough. So it's kind of weird that I have sort of, I think, right around 20,000 on both of them. I have less Twitter followers, which is just doesn't make sense. So yeah, get me up there. More Twitter followers, please. All right. Why does the VIX calculation use the 30 days SPX options to forecast for 1 year? Why not use 1 year SPX options to forecast what SPX will do in 1 year? Would it be more accurate? No, because, well, A, the volume is much better on 1 month forward options. So this is a little bit confusing because when we say what's the definition of the VIX, well, let me take that stupid Twitter thing off. You followed me on Twitter, right? Okay. The VIX index is a 30-day volatility index. So when we say that, it's based on a 30-day forward implied volatility expectation. So that might make people think that, oh, it's measuring 30 days, which it is. The measurement is based off 30 days forward options, right, of various strikes. Like I said, the volley index is at the money SPY options, and the VIX index is a number of strikes on the SPX options market. But the number is actually annualized. So when you say the VIX right now is, There's the VIX right now. 1661. What this is actually saying is over the next 1 year, the market, right, S&P 500 options players, all strikes, all long, short, every combination, the market is expecting within one standard deviation that the S&P 500 will move plus or minus 1660% a year. It's an annualized number. So the 1660 on the VIX is not a price. It's not, points. It's a percentage. It means plus or minus 16.6% variance over the next 1 year within one standard deviation, confidence interval. So it's a little bit confusing there. But yeah, this comes up a lot. So the VIX is a 30-day implied volatility index. It's just an annualized number. As to the second part, would 1 year be more accurate? I would say no. You could do the VIX on anything. But what we tend to do is, of course, the VIX is a methodology that uses 30-day options. That's how it's calculated. It could do 1 year, but it would be less accurate because less volume. 30-day is really pretty heavily used strikes. But you can change that 1 year annualized number by dividing by the square root of whatever you're trying to calculate. So I'm not going to do a very good job explaining it today on the fly. But if you want to get fully into this, VIX Index Explained on the YouTube channel, in this video, I actually explain what all those numbers mean. Let me go in here, pause that. There it is. That's lucky. So what you can actually do, if you don't want it to be an annualized 1 year number, like here's 16 on the VIX, 1 year. If you want to make it 1 month, you can just divide by the square root of, it's 15.87. You can divide by that. You can divide by 3.4641 to make it a 1 day. So you can basically determine, using a VIX that says 1660, you can determine what that means on a 1 day movement, which is, roughly 1%, because you're dividing, there's 252 trading days in a year. You divide by the square root of 252, which is 15.87, and you actually get a number of 1% per day, plus or minus on the S&P 500. But like I said, you can do this for various different amounts. You can divide by the square root. So depending on whether you want it annualized or not, you can go a little bit further. And you can make the VIX a 30-day 1 month. You just divide by 12, the square root of 12, right? 3.4641. You can do that if you want. If you want it to be a 30-day index showing the actual 30-day movement, you can do that. But you have to go that one step further, divide by the square root of what you're looking for, and then you're good to go. So typically the two that people look at would be either 1 month, right? Just memorize the square root of 12, 3.4641, memorize the square root of 252, 15.87, and just, do the VIX divided by that number, and you can do it yourself. But yeah, very confusing. The VIX is a 30-day, using 30-day options, but the actual number is an annualized percentage. So, but watch that video. I said all that in like 2 minutes, probably very confusing. So watch that 15-minute video. It's much better. All right, one more. There's 30 questions I didn't get to, so apologies to everybody. I'm going to try to just pick one out that looks kind of geeky, and I'm going to go into one last. This looks fine. Marky Mark. When calculating VRP, volatility risk premium, how do you calculate RV, realized volatility? When I use Excel to calculate rolling standard deviation of 20 most recent SPX log returns, I get very odd values. Is there something I'm missing? Is there something wrong with just using a trading software? Because here's the S&P 500, the SPX. Here's the 5-day historical. Historical vol and realized vol are the same thing. It's just, semantics. Here's the 5-day, here's the 20-day. You can go into any of these studies and you can do anything you want. I just get it from here. Obviously, Excel can do anything. And if you want to import your data and use the actual Excel functions, you can. But it's going to tell you what it is right there. This is just set up the way that I like to look at it, right? Personally, you can do anything you want. Mine are different, but 5-day historical, 20-day historical, implied volatility, which is very close to the VIX. It's not exactly, because this is the 30-day implied of the SPX, which is slightly different. But basically, you can see there, 1679, pretty close to the VIX. Difference between 20-day historical and 30-day implied is the baseline definition of VRP. So if you go to my simple VRP, I've got a trader's VRP that I think is way better, sort of my own calculation again. That's why it's specialty. But general metric, simple VRP, it literally is just 20-day historical. It's just 30-day implied, which is the VIX, minus 20-day historical. And you can get your 20-day historical in any trading software. You just, I get end-of-day values for everything. It's another reason why I trade end-of-day, is because all the data we have is end-of-day. It's pretty hard to get intraday values for anything, but end-of-day is just a breeze. Any trading software will tell you what it is. And that's what the VRP is, essentially. Baseline VRP. You could do variations of. I mean, we have, for my trader's VRP, which I think is much more suitable for trading, I have gone a step further, and here's the simple, but my trader's VRP formulas are there, and then here, and then here. So if you wanted to go through the whole calculation, I basically shared that with everybody. But yeah, get your values from trading software. Don't use Excel. Well, I can't tell you don't use Excel, but I use Excel for nearly everything, but I don't know why you wouldn't just pull end-of-day data from any source you want. You'll be able to get it. Whether the simple VRP is useful or not, you're going to have to determine that yourself. I personally don't base any trade decisions based on 30-day implied minus 20-day historical. I think it's just a conceptual for me. You just kind of want to know that typically there's a positive volatility risk premium. Should be the case. Human nature. We always overprice future unknown events, but yeah, get it from your software. Super easy. And apologies to everybody else who I didn't get to. Looks like there's some good ones there. Yeah, let's call it there. That was a good live stream. There was some useful information, hopefully in the early sort of 30 minutes there. So the next one we do, little teaser, I'll probably do something similar to the format today. We'll just do backwardation. We'll just flip it, and we'll talk about negative market periods, and maybe in preparation for something to come. I know the markets have been incredibly cooperative lately. Certainly that V-bottom bounce since COVID was pretty spectacular. But let's at least put it in the back of our minds that sometimes stocks do go down, and sometimes volatility does spike. I know it's been a while since we've seen it for longer than a day or two, but it's coming. At some point, it's coming. So let's prepare. Let's understand what backwardation is, understand what very negative markets look like, and then, we'll just be better traders. So thanks, everybody. What am I going to do today? I went running yesterday, so I'm just going to chill today, do some work. So hopefully everybody has a great weekend, and we will do the next live stream next week.